Hi, good morning, everyone, and welcome to our first of a series of Tobias Wealth Wisdom monthly chats. I appreciate everyone joining. I'm really excited to be here today with Marinella Collado, our CEO, to talk to you all about health savings accounts, which we like to call the tax trifecta investment opportunity. We're going to spend a few minutes here sharing some wisdom from Nella and taking your questions. Just a few housekeeping items. If you do have questions that you would like to ask in the webinar software, you'll find a chat or a Q&A section where you can ask your questions. If we don't get to your questions during the conversation here today, we'll make sure to get back to you. With that, I'd like to first a couple of important disclosures. As you know, this is general information. It's not the rendering of specific advice, but we do hope that it's useful and will be helpful to all of you. We're going to spend a little bit of time with some questions and a conversation with Nella about a topic that a lot of people kind of hear about, they know about, but they may not be fully utilizing it given all the benefits. So we have Marinella Collado with us here today. So welcome, Nella.
Like I said, thank you.
She's our CEO, CFP, personal financial planning specialist, and a CPA. And this is one of her favorite topics to discuss with clients and to take them through. So we're going to go through that. So I'll start with a question. Nella, if you can tell us a little bit about, how you think about healthcare costs in general when you're working on plans or you're thinking about financial planning, and then why something like an HSA is so important.
Yeah, so I mean, basically, clients need to think about the rising cost of healthcare, and it needs to be included in our projections. So we know today we kind of talk about the future of health insurance as a country, and we know that with any change, it just gets more and more expensive. So we're already seeing that health costs are rising at a rate much higher than the regular inflation rate. And for our projections, we pretty much assume that all of our living costs today are rising at a rate of 3%, which we think is pretty conservative, given that historically, inflation has been around 1.7%, 2%. So we try to stay conservative there so that we also try to capture some of the healthcare costs. But we know that's going to be a big item in our clients' cash flow and needs in the future. So I think just to give people a ballpark, a couple might estimate that over the course of their retirement, they might need at least $200,000, almost $300,000. And that's just in today's dollars. So it makes more of a, case in point in needing to make sure that clients are thinking about this now, and that we are not only saving in a way that is going to be most advantageous, but actually making sure that the portfolios are positioned in a way to be able to meet those needs.
So can you tell us a little bit about, what is an HSA and how should we think about HSAs?
Yeah, so I say HSAs are one of my favorite topics because I call it almost the triple crown of investment accounts. It is the only savings vehicle out there that allows you to get a deduction on the way in. So you're getting the deduction on the way in. It's growing tax deferred, tax free. And then those distributions in the future will be tax-free if used for qualified medical expenses. So we've really been encouraging our clients to think about health savings accounts very, very differently than what the traditional health savings accounts like flex spending accounts. Those are very different than health savings account. Because these accounts are so powerful, we've actually been encouraging our clients to pump in as much as they can in there and actually not use it for current medical expenses. So this really serves to be the triple crown of investment accounts. This is beyond even the Roth IRA, because the Roth, while it's a very powerful savings vehicle, is out, HSAs beat the Roth IRAs just because you're getting that deduction on the way in. So definitely one of my favorite planning tools in my toolbox. And the way I like to help clients think about this is that when they're making a decision on what health insurance to apply for, to consider the fact that in order to be eligible for these types of accounts, you need a particular type of health insurance. So kind of crunching the numbers on what the premium savings are going to be versus the potential out-of-pocket cost, because in order to be eligible for a health savings account, you do need to have a high deductible health insurance plan. So sometimes this is a hindrance for people, especially if they have any type of pre-existing medical condition. They may need to think about whether it makes sense to go with a high deductible health insurance plan if they're going to be out of pocket a significant amount of health costs just because of any pre-existing medical conditions. So I did want to touch a little bit about not everyone is able to just set up a health savings account. So you do need to make sure that the health insurance plan that you do have is HSA eligible. And that's a key thing. And again, just kind of crunching the numbers on what is the cost if I go with an HSA eligible health insurance plan. And I know election time for our employer benefits are around the corner. And even for those that have insurance themselves, November is usually the time to make these elections. So if I would encourage folks to kind of look at the opportunities to get an HSA eligible health insurance plan and see if that works within their budget.
Do I think about HSAs like a health insurance, or how do I really use it?
So HSAs are not a health insurance. They are a savings account. They were designed to help people have a lower cost of premium. So with high deductible health insurance plans, you have a lower premium, lower out-of-pocket premium, okay? And the reason why the health savings account was born is so folks who decided to go with a plan with a lower premium can take those savings and actually set it aside in a health savings account to cover the fact that they're going to have a higher deductible. So for you and I, for instance, so when we have a high deductible health insurance plan, when we're going to doctors, we don't have a copay. We're basically out of pocket until we meet that deductible. So the reason why health savings accounts are available is so that you can pay for those out-of-pocket deductibles, out-of-pocket costs with the HSA accounts. However, because they're so powerful, we haven't been using it that way. So I've actually said, you know what, let's just pay for those medical expenses out of pocket. Every time we go to the dentist, we're actually writing a check. We're not getting reimbursed from our health savings account. And that's because I prefer to let the HSAs continue to grow tax-free. And the goal is that when we're in retirement, when we have potentially higher medical expenses, we can then use those funds to cover those expenses in retirement. I can't hear you, Edgar.
Yep. So you talked about it a little bit, but can you go a little bit more into, what some of those, tax advantages are for HSAs? You mentioned a little bit about, tax-free growth, et cetera, but how exactly does it work? And, what do I need to tell, let's say my CPA, or what does someone have to tell their CPA when it comes down to how to treat an HSA?
Yeah, so it depends. If you have your health insurance through your employer and they offer a health savings account, you will most likely have the option to have payroll deductions to fund your health savings account. But if you do have a high deductible health insurance plan and your employer doesn't offer a health savings account option, it doesn't mean you're precluded from still funding a health savings account. You can always open up your own. As long as you have an HSA eligible plan, you can go on your own. There are a bunch of different options out there. One that we've been using lately is Lively, It's a brand new platform, but you can just go in, set up your own health savings account, and you make your own contribution. Now, if you're getting the payroll deductions to fund your health savings account, then you don't have to worry about the deduction on your tax return, because on your W-2, they will reflect the fact that those contributions to your health savings account are pre-tax. So they reduce your taxable wages by the amount that you've opted to contribute to your HSA. Now, if you don't have an HSA through your employer and you opened your own, you were proactive enough, you opened your own, you funded it, you have to make sure that your accountant knows that you made those contributions to your own HSA, so that you'll see on your 1040 what happens is there's a deduction pretty much above the line. And that's the beauty of it. It's also an above the line deduction. So it doesn't matter if you're itemizing or not, it's basically reducing your adjusted gross income. So that two ways with employer versus not, you can always set it up as long as you have the type of health insurance that makes you eligible for the HSA. Then to touch on what happens. So you funded your HSA and basically it's growing tax-free. You're not paying tax on any of the earnings. Some of the things that we have seen is that, well, people say, okay, great, Nella, I did step one. I funded the HSA, and then I cheer them on because they did the right thing. But then they say, well, I now have like 30,000 in there and it's sitting in cash. And then I'll say, oh my God. So cash is not earning anything. So it's great that we did step one, but step two is where rubber meets the road. This is where you can put this plan on steroids, because what I also encourage, as you know, we did for our own health savings account, is that we basically invested it. For instance, through Lively, you have the option of setting up an account with TD Ameritrade, and then we actually loaded that health savings account with really growthy investments. So I think we may have loaded it with emerging markets, large cap growth, but the point is that what you want in your health savings account are investments that have a really high projected rate of growth, because the goal is that you're growing this pool of funds that will be able to cover all your medical expenses at retirement. Now, so you've funded it, you've invested it. Now, I said, now you're not going to use it. So you're really confused, but you're not going to use it. But what we're doing, Edgar, as you know, is we're tracking all of our medical expenses, because the beauty of an HSA is that from the moment you open up the HSA, any qualified medical expenses you incur from that moment on are eligible to be reimbursed or withdrawn from the HSA to cover those expenses. The beauty of this is that it doesn't matter if it was today or 10 years ago. So what we're doing is using the app for the HSA plan is we're recording all our medical expenses. So I envision that in 15, 20 years, when we want to take $1,000 or maybe $5 to go on a vacation, we'll be able to apply medical expenses from 10 or 15 years ago to be able to take a tax-free distribution. That's where, that's the power in the HSA, is that, and sometimes actually, like when I meet a new couple and maybe they're thinking about starting a family, and so maybe they just got pregnant, but they don't know how much it's going to cost to deliver the baby. Immediately I say, well, do you have a high deductible? After I say congratulations. And then I say, do you have a high deductible health insurance plan that makes you eligible for an HSA? And they say, yes. What do you know? I do. So then I say, what you should do immediately, just open it up, even if you fund $1, even if you just add $1, because what you're doing is you're starting the clock. Because from that point on, any medical expenses that you have, you can run through there. Even if you don't have the cash flow to necessarily do what we're doing, where we're not using it to cover medical expenses, what you're trying to do is still run those medical expenses as an above the line deduction. So let's say you fund it for $1, you start incurring all the, kind of prenatal costs, you're visiting the doctor, you have the baby, and now you know how much it's going to cost you all in. You can just make the deposit to your HSA, so you get that above the line deduction, and distribute the same amount to cover those medical expenses. And what you're doing there is you're in essence converting what would otherwise be an itemized deduction that you're not going to get a benefit for, because the threshold to deduct medical expenses is so high that you never want to be that ill. So what you do is you basically run it through the HSA, so you've converted that to an above the line deduction. That's another little trick I like to tell people about. And then as we talked about, I think the power in that HSA is really making sure that you're investing it and that you're looking to grow it as much as possible.
So if I have an HSA, even if I don't, let's say I don't max it out or I'm not investing it, let's say I need like a dental surgery and it's going to cost me $2,000. I could take that $2,000, put it in my HSA. I would get a tax deduction for that $2,000, and then I can just take that right back out and pay the dental expense.
Correct.
Okay. Is there, I mean, what's the maximum, I guess, that I can put into an HSA?
Very good question. So there is a maximum depending on whether you have an individual health insurance plan or a family plan. If it's just an individual plan, and again, you made sure it is an HSA eligible plan, then for 2020, the maximum is $3,550. And for 2021, it went up $50, I believe. So now it's $3,600. But they also allow you to have a catch up. So if you're over 55, that's an extra $1,000. And a little unknown neat trick regarding the HSAs is that catch up applies to both spouses. So if we've been doing this lately where the husband has the HSA through his employer, but now they're 55, so he's doing the catch up through his employer. But in order for the wife to do her catch up for that HSA, she has to do it outside with her own HSA. So we open it separately for the spouse so that she can start doing the catch up. So it's for 2020, $3,550 for an individual plan plus $1,000 catch up. And then if it's a family plan, that's $7,100 for the family, which is what we're doing. And then when we turn 55, just to give us something to look forward to, we'll be able to add the catch up of another $1,000 each.
So what if something happens and someone needs the money, before they turn 65? I mean, what are the consequences of putting putting in the money and leaving it in an HSA?
So, I always remind people this is going to be the pool of last resort. You don't want to immediately think this is where I'm going to go. I have an emergency and I'm going to go pull it out of my HSA. I may just cry if I hear that, but you don't want to try to avoid that, because if you do have to take a distribution and you don't have eligible medical expenses to apply towards that distribution, you're in effect looking at a 20% penalty on top of the income tax. So not only are you going to pay tax, because remember, you got a deduction on the way in, so any dollar out is now taxable, on top of a 20% penalty. So they really want to discourage any distributions out of an HSA if it's not for medical expenses.
So that's if I'm under what age? 65?
65. And then after 65, to give us something else to look forward to, after 65, basically this becomes like an IRA, a traditional IRA. So like with an IRA, if you take a distribution, you're going to pay tax, but no penalty. So at 65, it kind of shifts over and kind of mirrors the behavior of a traditional IRA.
And if I use it for medical expenses, I pay no taxes.
Exactly. So this is why, I'm a big stickler about receipts, because we need to keep those receipts to be able to track any distributions that we pull from the health savings account. So I keep my little pile of receipts, but now we're scanning them, so I don't have a big box of receipts. Because you can just scan them and just track them, and then you can apply them to any dollar withdrawn from the HSA.
So if you're using the HSA, or rather you have, and you're contributing to an HSA, you're not using it for medical expenses, you're investing it. It's really important for people to keep copies of all their receipts. That includes kind of medical visits, prescriptions, and then at some point, I guess the idea is that I would just then submit all these for reimbursement after that money has grown, over, 10, 20, 30 years.
You don't really submit them anywhere, but yeah, you're basically applying it towards it. It's kind of the IRS is not really going to ask you for the receipts, and neither is the HSA custodian. They're not monitoring this, but you should have it, because if you are one of the lucky few to be audited on a distribution from a health savings account, one of the things they will be looking for is, show me the medical expenses that you apply towards this distribution. So you want to have a good record of it, a way just to prove how you calculated that distribution was for medical expenses.
Okay. And then I guess the last question is, we hear this a lot, people have a lot of options for how to invest and how to prioritize their savings, whether it's for retirement, for medical, or what have you. Can you talk a little bit about, how someone should prioritize, let's say, funding an HSA versus maybe funding their 401k or another, savings vehicle?
And I just have to say, I love this. This is like, such clear guidance on where do you go first, because I think sometimes people just get stumped with, I know I want to save, but where do I save and how do I do it? And, why do I pick this one over this one? So this is a really nice kind of roadmap on where to start. So remember I said you don't really ever want to go to a health savings account for an emergency, and that's because before you put $1 into that health savings account, you would have already had your emergency reserves. And this is what would cover any type of situation where you need access to cash so that you're not going directly to the HSA. So that's always step one for us as planners. It says 3 to 6 months, but if COVID has taught us anything, is that maybe it should be 12 months. So anyway, that's a conversation that we'll have with you individually to see what's appropriate. But then the next one up is we never like to leave money on the table. So depending on the employer benefits, you may have a program where you have a match on any HSA contribution. So that always comes first, again, because it's such a powerful savings tool that you want to make sure you go there first so that you can get the eligible match. So HSA is so powerful. If it has a match, that's your first stop. Then you're going to contribute there up to your match. And then you're going to move to number 3. So that's your 401k. Your 401k might have a match. So you're going to do the 401k contribution up to the match, because again, you don't want to leave money on the table, and that could be significant. For the most part, if you have a matching program, it's usually 100% of the first 4% you put in. That's usually what the numbers kind of work out to be. So that could be a lot of money that you would leave on the table if you don't contribute to your 401k. And then of course, if you have any loans, we kind of want to get rid of those debts, and then you go back to the health savings account. So in step number 3, you may not necessarily be doing the full $19,500 that you're allowed to contribute to a 401k, because you're going to revert back and try to maximize the HSA first. Again, that's how powerful it is. And then after you've maximized the health savings account in step 5, then you go back to maximize the 401k up to the 19,500 or 26,000 if you're over 50. So this is a good guideline. But again, if anyone's confused, we can kind of walk you through what that would look like for you and how we would start, because everyone has unique set of circumstances, so we may need to switch things around, but this is a good guidance.
Great, thank you. So we're going to go ahead and open it up for questions. As I mentioned earlier, the webinar software has a chat or Q&A section that you can put your questions in, and I do see that we have a couple of questions here already, so we have about 5 minutes or so for questions. Thank you, Nella, for that. That was really helpful. So the first question we have is, if I have not been keeping receipts, can I get a historical kind of medical expenses from my insurance companies or anywhere else for that matter?
Yes, I know, like, for instance, Walgreens, if you get your prescriptions at Walgreens, they might be able to print a really nice report. I think even Publix did that for us a couple of years ago. They printed a nice kind of summary of all the prescriptions. But yeah, you can go back and try to recreate those records. And I'm assuming that, you know, they didn't get a deduction for it because you really can't double dip. But in effect, yeah, you can go back and just try recreating those receipts so that you can have them to apply to future distributions.
Great, thank you. The other question is, can an HSA be inherited by a spouse or a child?
Yeah, so very good question. So the spouse is, again, the spouse always gets preferential treatment. With an HSA inherited by a spouse, she basically has the same benefits to treat it as her own HSA, able to get the same tax-free distributions for medical expenses. Non-spouses have different treatment, and I believe they just basically get treated as a regular IRA for non-spouse beneficiaries. And I'll double check that because I know they have different treatments. So spouse gets the same, it kind of gets treated as their own health savings account. Non-spouse beneficiaries have a whole different set of guidelines.
Can an HSA be rolled over? So if I have one with a company and then I left that company and I want to do something else with it or put it somewhere else, can you roll over an HSA?
Yeah, if you remember, you had yours was with Optum Bank, which was the one funded through Ingersoll Rand. And then when you left, we pretty much converted it over to Lively. So it was like the Ingersoll Rand funded HSA, and then we just converted to our own personal.
Okay. So thinking about, this is another question, thinking about how I can use the HSA funds. Can I use it to pay insurance premiums down the line, right? So we looked at the medical chart before, so, or Medicare. So you have Medicare, you know, kind of gives you a basic, but if you need additional insurance and you're paying insurance premiums, can we use that, the HSA to pay for those premiums? Or even if it's other coverage like dental or vision that you want to add on?
So there's an IRS list of qualified medical expenses that we can share with folks. So it has to meet the IRS guidelines of an eligible or qualified medical expense for it to be an allowable tax-free distribution. Cobra, I have to look because there's special rules with Cobra, but as long as it's in the IRS qualified medical expenses list, it would be a tax-free distribution from the HSA.
Okay. And then let's see, I think I have one more question here. So how have enormous health costs impacted the insurance companies? What do you know about that?
Well, I think we're all feeling it in the way of higher premiums, you know, especially harder for employers. You know, not all I should say, before, you know, most companies were really good about covering a lot of the employees' healthcare, health insurance. And that's kind of grown astronomically to the point where companies started passing through a lot of the costs to the employers. So definitely there is, it is affecting the employees because now they might be kind of splitting that cost with their employer. So we're definitely feeling the impact. I mean, for people who don't have the option of having a company provided health insurance, it's really expensive to get an insurance plan on your own. Now with the marketplace, and the whole premium tax credit, if you qualify with lower levels of income, you might be able to get some of the premium subsidized under the whole Affordable Care Act. That's kind of being questioned now, but definitely it's affecting cash flow. If you don't have that option of having a company provided health insurance, it's really costly to get it on your own. In fact, some clients will say, I do want to retire before 65, but I wouldn't be eligible for Medicare until 65. So they're choosing to do some like part-time work that would You know, I had one client say, I'll just work at Home Depot part-time just to get health insurance. So people are making those choices because it's a big item. I mean, I have a client, she pays $1,700 a month for single coverage. So it's a big budget item.
Well, I think that's all the time that we have today. So thank you, Nella. I really appreciate you taking everyone through health savings accounts. And I thank everyone for joining us today. Look out for future emails on the Tobias Wealth with Wisdom chat series. You're going to get an opportunity to hear from other advisors and planners on the team. So thanks again, Nella. Thanks, everyone, and
Thank
have
you.
a great day.
Thank you.